Here, live.
Yes, yes, yes. Share screen access, Suraj.
Just a second.
Yeah.
To the host.
Done.
Yeah, we are live.
Yes. I hope the screen is visible. Yes, hello, my dear friends. Very good evening and a warm welcome you all to the discussion on the CA Inter Marathon GST. What we have been discussing few days ago, where we discussed about the part one of our session, where we had so many interesting points to talk, especially the topics of the basic concepts. We discussed about the beautiful concept of time of supply, composition scheme, whatnot. So a lot of interesting areas we have discussed. So now it's time to talk about some more interesting topic, that is value of supply, and also some interesting topic known as input tax credit. And we'll also try to spend some good time on few more small topics also. Clear? Yes. A very good evening, very good evening, good evening, good evening. Yeah, done. So already some question has been asked. So what topics we are covering? As I told you, we are going to cover value of supply, and we're also going to cover input tax credit, and few more small balance topic which are left out. That also will cover up, and we'll complete this discussion. So that will be done with our marathon, and we are geared up for our exam. And not that today's session is over, our marathon is done, our communication is done. Even after today's session, any doubts, any queries you get, you can comment on the video, I'll reply, or the best possible way to ask your queries is on IndigoLearn platform, we have got an option known as forums. Any query you have got, you can feel free to post your query on the forums, and we'll be extremely delighted and happy to reply to your query. Because the more and more queries you ask, the more and more excited we are, and more happy to answer your queries. Done. So without delay, my dear friends, let's start the discussion of the next interesting topic. Yes, hello, hi. Shall we wait for a minute and then start, or shall we go ahead? I think better we'll go ahead, guys. Sure, good enough. Come on. So friends, let me start discussion about the next interesting topic, that is known as none other than value of supply. In fact, that's an interesting topic which keeps coming in the exam so many times, especially for 4 marks. Sometimes it may come for 5 marks also. Come on, guys. What is the topic I want to discuss with you? I'm going to talk about value of supply. And good thing in your syllabus is that you don't have valuation rules. You have got only discussion in your syllabus about section 15. That's it. In your syllabus, you don't have valuation rules. So when I talk about value of supply dealt by section 15, now why is that this topic is important? Now don't tell me that, sir, 4 marks will come, 5 marks will come. That's why important. That's not the way to learn. See, any topic you learn, there are 2 important things you have to keep in mind. Number 1, especially CA Inter students should have to keep in mind that CA final level, this indirect taxes paper is there for 100 marks. That's the first thing you have to keep in mind. And the second important thing you have to keep in mind very clearly is, my dear friends, this subject is not just some subject which you will learn for exam, write the exam and then forget. It's not like that at all. This is one such beautiful subject where you definitely have to utilize this, use this, work on this practically. So GST is one such area, wherever you go, GST will follow, no doubt about it. So now, why is this topic value of supply important? Now, value of supply is very important for a simple fact and reason that ultimately we are going to charge GST as a percentage on the value of supply. Now, whenever we are going to charge GST as a percentage on the value of supply, now what is the value that we will consider for the purpose of calculating GST? Because sometimes it does so happen that what all we will add, what all we will reduce from the value of supply. That's very important. Correct? So for example, let me ask you a small question. See, let's say, for example, we go to some store to purchase one shirt. When we purchase one shirt, the shirt costed 1,000 rupees. At the billing counter, that gentleman asked, sir, do you want a cover? Of course, human tendency, we always say, yes, we want a cover. and those people may charge extra amount for that cover or some extra amount for packing of the costumes or packing of the goods what you have purchased. Now, question is all about, will that packing charges be included in the value of supply? Definitely answer is yes. But what all are covered here? What is covered, what is not covered? That is what we need to understand here. So, in our discussion, we are going to talk about 15.1, 15.2, and of course 15.3. These three areas we are going to talk. Now 15.1 says, value shall mean transaction value. I repeat, my dear friends, value shall mean what value, my dear friends? Transaction value. That is price paid or payable when supplier and recipient are not related and price is sole consideration. Come on, my dear friends. This language is a very, very interesting language which you need to understand very clearly. What is the language we use? Value of supply. Section 15.1 says value shall always mean what value? Transaction value. Come on. Value shall always mean transaction value, which refers to what? Transaction value means price paid or payable. Price which is already paid or it is payable when supplier and recipient are not related and the price is sole consideration. That's quite obvious because it is very important that they both should not be related, because if they both are related, the price will not be a normal price. Price will be a affected price. Obvious to know, my dear friends. And moreover, interesting point you have to observe here, there is a language called price paid or payable. On this language, one question came in the exam on time. Some question is like this. For example, Shiva Teja has given service to a particular client. When I've given service to a particular client, I told the client, boss, you should make payment within 30 days. If you don't make payment within 30 days, after that, I will charge extra interest. Now, one of my client, let's say, he paid on 31st today. That means there is a delay of 1 day. Now, for that 1 day delay, I should actually charge interest from my client. Yes or no? But what I have done is, I did not charge that interest. I have waived that interest. I told my client, it's okay, my dear friend, don't pay the interest, it's okay. So the interest has been waived. Now, the question is all about, will that interest be included in the value of supply? They have clarified that very clearly. Answer is no. The reason being very clear that value of supply shall always mean price paid or payable when supplier recipient are not related and the price is sole consideration. So what is included is only what is paid or what is payable. Now, this particular interest, what we are talking about, it is no more paid or payable. Now, when it is no more paid or payable, there is no question of including that in value of supply. What will include is only that which is paid or payable. That too when supplier recipient are not related and the price is sole consideration. Very important points. Then 15.2 deals with the concept of, come on friends, 15.2 deals with the concept of inclusions to transaction value. 15.3 talks about exclusions from transaction value. So what all will include, what all we will exclude. So 15.1 talks about what is meaning of value of supply, which says value of supply shall always mean price paid or payable when supplier recipient are not related and the price is sole consideration. And 15.2 talks about inclusions to transaction value. 15.3 is what? Exclusions from transaction value. See now. Let me talk about section 15.2. Inclusions to what? Transaction value. Now, what are all included in transaction value? Come on, friends. First one, any tax, duty, cess, fees, etc. Except TCS under income tax. Friends, I'm sure you would have heard about the concept of TCS under income tax. A classic example, let me tell you, whenever you buy a motor car for more than 10 lakh rupees, the seller will collect extra 1% as TCS. Correct, friends? So any tax, duty, cess, fee, etc., except TCS under income tax. Any tax, duty, cess, fee, except TCS under income tax charged by supplier from recipient. That will be included in value of supply. Come on, first one, any tax, duties, cess, fee, etc. except TCS charged by supplier from the recipient. That will be included in value of supply. Let me give a classic example. See, for example, there is a property, right? The property is given on rent. Now, on the rental income, will GST apply? I'm sure we know the concept that if a residential property is given for residential purpose, GST will not apply. But if a residential property is given for commercial purpose, or commercial property is given for residential purpose, or a commercial property is given for commercial purpose, then definitely GST will apply. Correct? Now, Shiva Teja has given a property on rent to one person known as Ravi Teja. Now, what will I collect from him? I'll obviously collect rent. Now, on this particular property, I'm required to pay some tax to the municipal authorities known as municipal tax. Now, that municipal tax, which I am responsible, I took that money also from my tenant only. So, owner collected the amount of municipal tax also from the tenant only. Now, what law is telling? GST will apply on the municipal tax also collected by supplier from recipient. That's why they use the word any tax, duty, cess, fee, except TCS under income tax charged by supplier from recipient. Second, supplier's obligation. Whose obligation? Supplier's obligation in relation to supply is met by recipient. Come on, what a lovely language, friends. Supplier's obligation in relation to supply is met by recipient. That means some expenditure or some amount which supplier was supposed to incur, that was incurred by recipient. Third one, any incidental expenses. Classic example for incidental expenses is packing charges, design charges and all. Any incidental expenses or anything charged by supplier from recipient. So friends, for the first one, any tax, duty, cess, fee, etc. except TCS under income tax charged by supplier from recipient. Second point, supplier's obligation. Come on, whose obligation? Supplier's obligation in relation to supply is met by recipient. Third, any incidental expenses or anything charged by supplier from recipient. Then fourth point, any interest, late fee, or penalty charged by supplier from recipient. I already given an example where I have given some service to my customer or client and I have told him that you have to make payment within 30 days. If you don't pay within 30 days, after 30 days, we will charge interest. Now that interest is also included in value of supply. But the interesting point here is, which you have to observe and always keep in mind, that is, this is regarded as inclusive of GST. Come on, what is that line, my dear friends? This is regarded as inclusive of GST. That means whatever interest or penalty we charge, we always treat it as if that amount is including GST. So how do we determine value if it is including GST? 100 by 100 plus rate. If you want only GST amount, rate by 100 plus rate. No doubt about it. If you want only GST amount, rate by 100 plus rate. If you want value amount, 100 by 100 plus rate. That's a very clear cut point what you have to note. So friends, how many points done so far? 4 points are done. What are the first point? Any tax, duty, cess, fees, except TCS under income tax charged by supplier from recipient. Second point, supplier's obligation in relation to supply met by recipient. Third point, any incidental expenses or anything charged by supplier from recipient. Fourth, any interest, late fees or penalty charged by supplier from recipient. Is charged by supplier from recipient. Finally, last one. Any subsidy linked to price. Any subsidy linked to what's a price. except subsidy from central government or state government. So what is fifth point, my dear friends? What is 15.2e? So please remember, my dear friends, this is 15.2a, 15.2b, 15.2c, 15.2d, 15.2e. 15.2a says any tax, duties, cess fees, etc., except pieces under income tax charged by supplier from recipient. 15.2b. 15.2b is what? Supplier's obligation in relation to supply met by recipient. 15.2c, any incidental expenses or anything charged by supplier from recipient. 15.2d, any interest, late fees or penalty charged by supplier from recipient. And generally, we always treat that amount as inclusive of GST. Finally, last one, 15.2e, any subsidy which is linked to the price. Any subsidy which is linked to the price. Any subsidy linked to the price. Any subsidy linked to the price except subsidy from central government or state government. Any subsidy linked to the price except subsidy from central government or state government. Such an interesting point. No doubt about it. Yeah, some query. What is the student asking? Waiting for this. Wonderful. Enjoy them. So any doubts you ask? Yeah. So what are the 15.2 minus 15.2 deals with what? Inclusions. How many points are there? 5 points are there. First one, any tax, duties, cess fee, except GST, except pieces under income tax charged by supplier from recipient. 15.2b, supplier's obligation in relation to supply met by recipient. 15.2c, any incidental expenses or anything charged by supplier from recipient. 15.2d, any interest, late fees or penalty charged by supplier from recipient. Last one, any subsidy linked to the price except subsidy from central government or state government. Finally, let me talk about exclusions. 15.3a, 15.3b. A will not take some time, but B will take some time because there are a lot of concepts in B. What is 15.3a? 15.3a says discount recorded in the invoice. Come on, friends, what is the language given? Discount recorded in the invoice. That's it. They never told trade discount, cash discount, quantity discount, turnover discount, this discount, that discount. Nothing is mentioned. Only thing mentioned is what, my dear friends? Discount recorded in the invoice. So any type of discount which is recorded in the invoice, that is reduced. For example, we go to a shop, we want to buy one phone. That phone costs 50,000 and is given 20% discount. So 20% discount is how much? 10,000. Net is charging only 40,000. Now GST will apply only on 40,000, and that's but obvious. 15.3b is interesting. See here carefully. The language also is very, very interesting. 15.3b, discount given after supply is made. So generally discount is given at the time when supply is being made. So I repeat, my dear friends, generally discount is given at the time when supply is made. But we're talking about a special interesting concept now. What is a special interesting concept? Discount is given after supply is made based on agreement existing at the time of supply. Conference. I repeat again, what is the language I'm using? Discount is given when discount is being given after supply is made based on agreement existing at the time of supply. And proportionate credit is reversed by recipient. And why that language reverse is coming is for a simple fact and reason that whenever first supply is being made, receiver would have already enjoyed the full credit. Then supplier has made a supply, receiver would have already enjoyed full credit. When receiver already enjoyed full credit, what law is telling them? Receiver, my dear receiver, you got some discount. That is, discount is given after supply is made, but agreement is existing at the time of supply. And it is also important that and link it to invoice. That means we clearly know that to which invoice related, we are giving that discount. to which invoice related we are giving that discount. We clearly know to which invoice related we are giving that discount. Come out of the language, my dear friends. Discount given. Come on, discount given when? Discount given after supply is made. Discount given after supply is made based on agreement existing. What is existing? Agreement existing at the time of supply. And proportionate credit is reversed by the recipient. So receiver, to that extent of discount what he got, whatever credit he enjoyed, he has to reverse the credit now. And very, very logical point. So simple way to tell 15.3a deals with discount is discount given at the time when supply is made. In the invoice only it is recorded. But 15.3b talks about discount given after supply is made, post supply discount, which is based on agreement existing at the time of supply and is linked to the invoice, and proportionate credit is reversed by the recipient. So going back, my dear friends, let's look at our notes. See, come on. GST is always levied as a percentage of value of supply of goods or services. That is the reason why it is important. And let me tell you, my dear friends, there are a lot of interesting valuation rules which are not there at CA inter level, but at CFL level, we have got a lot of interesting valuation rules. Then, between two persons who are not related to each other, and price is the sole consideration. That's why I clearly told you value of supply means price paid or payable. Price paid or payable. When supplier and recipient are not related, price paid or payable. When supplier and recipient are not related and the price is sole consideration, then only we include that in the value of supply. So value of supply means what? Price paid or payable. When supplier and recipient are not related and the price is sole consideration. That's it. Next point. And who are related persons? Would have already learned this concept in supply chapter, my dear friends. Office directors, legally recognized partner, employer-employee, 25% or more. One of them is controlling other. Third person controls both of them. They together are controlling third person. Members of the same family. Family means what? Spouse and children. Parents, grandparents, brothers, sisters are covered only if they are dependent. How dependent? That too, wholly or mainly dependent. Then one of them is sole agent and all. Inclusions. But first one, any tax, duties, cess, fee, charges and all except GST. Of course, we will not include GST for calculating GST. And special point, already I told you, for the purpose of determination of value of supply under GST, tax collected at source under Income Tax Act would not be includable as it is only an interim levy, not having the character of tax. Classic example, when you buy a car for more than 10 lakh rupees, the seller will collect extra 1% as TCS. And that TCS under income tax is not included in the value of supply. Next point. 15.2b, supplier's obligation in relation to supply is made by recipient. So on behalf of supplier, recipient is making payment. Next. 15.2c, any incidental expenses like commission, packing, design, all those things will come into picture. But what interesting like you see here, outward freight transit insurance. Read that language, where the supplier agrees to deliver the goods at the buyer's premises and arranges for transport and insurance. The contract of supply becomes a composite supply, and GST is payable at the same rate as applicable for relevant goods. Obviously, however, if the contract is on ex-factory basis, that means what? Customer only should come and pick up. Where the buyer pays, where the buyer himself pays the outward freight and insurance, the same will not be included in the value of supply, obviously, because it was not a supplier obligation made by recipient. Good. Somebody is asking you an interesting question. What is that, sir? Sir, what is the time of supply for goods sent on approval basis? My dear friend, let me tell you. See, in case of goods, time of supply is always the date of invoice. Payment date is not relevant at all. Only date relevant is date of invoice. Now, what is date of invoice? Actual date of invoice or last date when invoice is ought to have been issued, whichever is earlier. Now, in case of goods sent on approval basis, when invoices ought to have been issued is when it has been approved or 6 months from the date of removal. So 6 months from the date of removal or if it is approved, whichever is earlier generally, that time invoice is supposed to be issued. So actual date of invoice or last date when invoices ought to have been issued, whichever is earlier, that becomes your time of supply. I hope your question is clarified. Good, very good. Next, 15(2)(d). Any interest, late fees, or penalty which is charged by supplier from recipient, and already we learned about the concept of time of supply related to this. What is time of supply? Time of supply is the date when amount is received, where we discussed about 12.5, 12.6 actually. 5 is a residual case. 12.6, 13.6. An interest, late fee, penalty charged by supplier from recipient. For that, the time of supply will be the date when addition in value is received. Finally, subsidy. Any subsidy linked to the price, except those given by central government or state government. Discount, two types. Number one, discount which is recorded in the invoice. Very, very interesting language. Number two, post-supply discount. In this, the conditions to be noted is very clearly, my dear friends. Discount is in terms of an agreement. There must very clearly be an agreement that exists at the time of supply and can be worked out invoice-wise. That means what? There should be an agreement which is existing at the time of supply and it is linked to an invoice and proportionate credit. What credit, my dear friends? Proportionate input tax credit is reversed by the recipient. The buyer would have availed ITC of GST payable on the gross value specified in the invoice. Thus, when a credit note is issued to him, obviously there will be a credit note because I'm sure you know that whenever there is an increase in value, for that supplier will give a debit note. For reduction in value, supplier gives credit note. So to reduce the value or reduce the tax, supplier gives credit note. To increase the value or increase the tax, supplier gives debit note. And I'm sure we know that this concept of credit note, debit note is given by section 34, which clearly says credit note must be reported in the month in which credit note is issued, or it can be reported in subsequent month also. But the maximum time limit is due date of return for September month, following the end of financial year, or a date of filing annual return, whichever is earlier. But in case of debit note, they clearly told debit note must be declared in the same month in which debit note is issued. They did not give more time. And very logical also. Why? Because in case of debit note, the tax is increasing. So government doesn't want to give time. But in credit note, the tax is reducing. That's why government gave time and told you have time till next year, September was. You have time till due date of return for September month, following the end of financial year, or a date of filing annual return, whichever is earlier. Clear? Excellent. Yeah. Just give me 2 minutes, my dear friends. I'll just be back. 2 minutes. Yeah, sorry. There was some technical issue, so I had to fix that issue. That's where I took that 2 minutes time. Thank you so much for your cooperation. Come on, friends. So what are we talking? 15.3 deals with what? Exclusions from value of supply. What are the 2 points we had got? Number 1, discount recorded in the invoice. Number 2 is what? Discount given after supply is made based on agreement existing at the time of supply, and it should be linked to the invoice. And very, very important point is that proportionate credit should be reversed by the recipient, and reversal is done by virtue of a credit note, where supplier gives a credit note, receiver will reverse the credit. I'm sure you know the concept that supplier gives a credit note in order to reduce the tax. In order to increase the tax, he'll give a debit note. Next point. So you can see this short summary. Discount at the time of supply, shown in invoice, then definitely yes. After supply, agreement should be there, link it to the invoice, proportionate credit reversed by recipient, then only yes. Very, very clear-cut point, my dear friends. Sometimes we get buy more, save more. In case of staggered discount, rate of discount increases with increase in purchase volume. Such discounts are shown in invoice itself. For example, they tell if you buy for 3,000, this much is discount. If you buy for 10,000, this much is discount. And that discounts are excluded to determine value of supply. And where it is periodic year-ending discount or volume discount, these discounts are given after supply is made. And let me tell you, they can be reduced only if there is an agreement existing at the time of supply. It is linked to the invoice, and proportionate credit. What credit, my dear friends? Proportionate credit is reversed by the recipient. Ultimately, it has to satisfy the parameters or the conditions given under 15.3b. If conditions are satisfied, then definitely will reduce. As simple as that. Next. Secondary discount. The discounts which are not known at the time of supply, that discount shall not be excluded. Obviously, no, my dear friends, we can reduce only that discount which agreement is existing at the time of supply. And if transaction value is not acceptable, we'll go to rules. And that rules is not there as a part of our syllabus. That is there for us only in CA final level. So with this discussion, my dear friends, we are done with this beautiful discussion of this concept of value of supply. Something interesting, high possibility that a question may trigger in the exam for 4 to 5 marks. And instead of saying high possibility, I would say definitely question will trigger in the exam. Because this is one such topic where every time question keeps coming in the exam. Next, let's go back. If you have any doubts, you can ask, my dear friends. Don't hesitate. So let me start discussion about another beautiful and fantastic topic. And of course, a very topic known as input tax credit. Yeah. What is the topic name, my dear friends? Input tax credit. And I don't think there is a need for me to tell that this topic is important. I'm sure you know why. Because input tax credit is one such topic where definitely sure shot, gunshot question will come in the exam. There has never been a case where paper has come without a question on input tax credit topic, because this topic has got so much of importance, where every time sure shot 101% a question will come in the exam from this beautiful topic known as input tax credits. And the point to be noted is, my dear friends, in fact, in input tax credit topic, we have from section 16 to 21. But in your syllabus, you have only 16, 17, 18. 19, 20, 21 is not there in syllabus at all. So only 3 sections is what you have in syllabus, 16, 17, 18. And you have got some interesting points of related to section 49. That's the only interesting points you have to learn. Clear? First of all, let's go back to some basics. That is, whenever we talk about input tax credit, friends, I'm talking about an interesting topic called payment of tax, where some good points are there. Payment of tax. Now let's say there is one person, Mr. A. His output tax is 100 rupees and his input tax credit is 70. Now, how did he get this input tax credit? He got this input tax credit because he would have paid some tax on inward supply, Now, whatever tax he paid on inward supply, that he will take it as credit. In general, it is always a thumb rule that the tax paid on inward supply can be claimed as credit, except those which are blocked under section 17, subsection 5. Except the block credit, any other thing, we can definitely take it as credit, provided it is related to our course or furtherance of business. That is very, very important. As long as it's related to the course of furtherance of business, then definitely we can take it credit. Now this 70 will take credit. Now let me tell you, when we take credit, we will take credit at the time of filing GSTR 3B. I'm sure we all know that there is something called GSTR 3B, GSTR 1. GSTR 3B is a monthly return. GSTR 1 is a statement of outward supply, where in GSTR 1, we only report outward supply. But when we talk about input tax credit, we claim that only in GSTR 3B. Now, once we claim the credit in 3B, my dear friends, this 70 will go and sit in one ledger called electronic credit ledger. What ledger it will go and sit? Electronic credit ledger. And if you observe carefully, 100 is my output tax and I have got 70 credit. If I have set off 70 credit, balance is what? 30. This 30 I have to pay using one ledger called electronic cash ledger. I repeat, my dear friends, when 100 is my output tax, I've got input tax credit of 70 rupees, which is there in my electronic credit ledger. Now balance 30 I have to pay using electronic cash ledger. Now, how will money come in electronic cash ledger? I always give a simple example to the student to get full clarity on this. That this electronic cash ledger is something like our Paytm balance. See, let me ask you one question. See, for example, you go to some store, okay? You want to buy some amount and you want to make payment only through Paytm app, okay? Now, from your account, you transfer money to Paytm account, and from your Paytm account, you will transfer to other person's Paytm account. Now, if that fellow says, sir, bill is 100 rupees, that 100 rupees, if you transfer from your account to your Paytm account, will you say the payment is done? No. Payment is done only and only when money is transferred from your Paytm account to other person's Paytm account. So this electronic cash ledger is something like a Paytm balance what you can maintain, which you can use it for the purpose of payment of output tax. And if there is excess balance in cash ledger, anytime you can claim refund. You can't take refund from credit ledger. Credit ledger refund is allowed only in certain exceptional cases, which you learn in CA final. Something called zero rated supplies and all, which you learn in CA final. But from electronic cash ledger, you can happily take refund because that is your money. Now, student can ask, sir, will I get interest if I keep the money for a long time? Answer is no. Law clearly told there is no question of any interest. There is no question of any interest on the balance in electronic cash ledger. As simple as that. That is the reason why generally people deposit only that amount, what they have to pay and what they have to meet their output tax. That much only they'll put in electronic cash ledger, nothing else. Are we getting clarity, friends? Everybody? Now, electronic cash ledger. I'll tell you an interesting point here. Please keep in mind. Balance in one head cannot be used for another head. Friends, I'm talking also about a chapter called payment of tax. So it's okay, no problem. That is also related to input tax credit. So please concentrate. Balance in one head cannot be used for another head. That means if you have balance in CGST column, you can't use it for SGST. Balance in IGST column, you can't use it for CGST. IGST balance, you have to use it only for IGST. That too, my dear friends, under IGST, there is something called tax, interest, late fee, penalty, others. If there is some balance in tax column, you have to use it only for tax. If there is some balance in interest column, you have to use it only for interest. So some practical problems have where, for example, some person has to pay some late fees for delayed filing of return. When he was supposed to pay late fees, by mistake, he entered the amount under penalty column and he paid. Come on, what he has done? By mistake, he entered the amount under penalty column and he made the payment. Now, what to be done? Before the problem was claim refund of that wrong amount and then pay the correct amount. Take refund of the wrong amount what you paid and then pay correct amount. This was a Herculean task. Because you yourself imagine we paid something, but we entered in wrong column. So they are telling now pay correctly again, then claim refund. Money is blocked. For that reason, they brought an interesting concept called PMT09 for transfer of balance. For what purpose, my dear friends? Transfer of balance. That means CGST balance can be transferred to SGST, SGST balance can be transferred to IGST, tax column balance can be transferred to interest column can be transferred to penalty column can be transferred to late fee column. Wherever you want, you can transfer. And this facility is only in electronic cash ledger, not in credit ledger. In credit ledger, there is a specific pattern, specific manner in which credit has to be utilized. You cannot utilize in whatever way you want. There is a specific pattern and manner which law has specified in which manner you have to use that credit. In that way only you have to use that credit. You cannot use whichever way you want. Getting clarity, friends? And I'm sure we guys know that in case where you don't pay the tax on time or you don't file returns on time, you'll end up paying the interest also. And interest concept is given section 50, which clearly says the rate of interest is 18% per annum. And if excess credit is availed, what is availed? Excess credit is availed or less output tax is shown. If excess credit is availed or less output tax is shown, then the interest rate is 24% per annum. In general, interest rate is 18% per annum. But if excess credit is claimed or less output tax is shown, then the interest rate is 24% per annum. Very, very critical point which you have to keep in mind. Now let's see, how do we utilize the balance in electronic credit ledger? How do we utilize the balance in electronic what ledger, friends? Credit ledger. Now see, we might have input IGST, input CGST, last one input SGST. Clear? Now see, input IGST, first we'll use it for output IGST. Then we have to use it for output CGST or SGST in any order or any manner. Friends, this line is interesting. Please see that. Yeah, come on, see that, my dear friends. What is the language I wrote? Input IGST. Input what? IGST. Input IGST. What is IGST? Integrated GST. And we know that very clearly that there are two types of supply. Intrastate supply, intrastate supply. Intrastate supply will charge CGST and SGST. Intrastate supply will charge what? CGST and SGST. Intrastate supply will charge IGST. And input IGST, first use it for output IGST. Then use it for CGST or SGST in any order or any manner. When I say any order, that means first CG, then SG, or first SG, then CG. When I say any manner, that means what? You can use it 60-40, 70-30, 50-50. Whatever way you want to use it, you can use it. And generally, practically, we sometimes use 50-50 percentage. So that, see, ultimately, there's nothing called hard and fast rule. You have to use 60-40, 70-30, 50-50 and all. The only logic to be kept in mind is that we'll use in such a manner where it is effectively utilized and there is optimum utilization. That's what is important. Ultimate objective is that we should have optimally utilized it. That is the ultimate objective. Clear, friends? Come on. So input IGST. Input IGST. First use it for what? Input IGST. First use it for output IGST. Then use it for output CGST or SGST in any order or any manner. Then second one, input CGST. First output CGST. Second output IGST. But we can't use it for SGST. Keep in mind always. Input SGST. First output SGST. Second output IGST. If you observe carefully, my dear friends, IGST is very, 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 very user friendly. We can use anything for IGST and IGST can be used for anything. That's why we say that IGST is very, very user friendly. But the two important principles to be kept in mind, that is Some important notes. Please observe carefully. Number 1. Input CGST cannot be used for output SGST and vice versa. That means we can't use CG for SG, we can't use SG for CG. And second important principle to be kept in mind. And this is very, very important. Input CGST or SGST to be utilized only after IGST credit is fully exhausted. Come on, friends. What is the second important principle? The second important principle to be kept in mind is that CGST, SGST credit. Come on, what is that credit? CGST, SGST credit. CGST or SGST credit has to be utilized only after IGST credit is fully exhausted. So first completely use IGST credit. Then only please touch CGST, SGST credit. That is what is very clearly given in the law. No doubt about it. And the third important principle, that is to pay output IGST. First, IGST to be used. First IGST to be used, then CGST, and only then SGST. This is an interesting language, my dear friends. Come, what is the line we wrote? To pay output what? To pay output IGST. When we have to pay output IGST, first we have to use IGST credit. That is always a principle. That is because we can't touch CGST, SGST credit unless IGST credit is fully exhausted. So when you have to pay output IGST, first IGST to be used, then please use CGST credit and then only use SGST credit. Without using CGST credit, please don't use SGST credit for paying IGST. For paying what? IGST. That's an interesting point to be noted. Three very, very important principles, and this is the manner of utilization of credit. And this way only credit has to be utilized. You cannot utilize in whatever way you want. This is a story of utilization of electronic credit ledger balance. So friends, input IGST first for what? Output IGST. Then for what? Output CGST or SGST. Any order, any manner. Then input CGST. First for output CGST. Then for output IGST. Input SGST. First output SGST. Then output IGST. But second important principle, keep in mind always that we can't use CGST, SGST credit unless IGST credit is fully exhausted. First, completely use your IGST credit. Then only please touch CGST, SGST credit. This is one very important principle given by the law. Please do keep in mind. Next point. We have got discussion about section 16, section 17, section 18. Three important sections to talk, which is very, very important. Come on, let's go back. So listen. There is one person, Mr. X, who made a supply to Mr. Y. Yeah? Mr. X will file something called GSTR1, and the supply happened in October month, and the GSTR1 is due on 11th of November. Correct, my dear friends? Now let me tell you an interesting concept and very practical concept. That is, whenever the gentleman files GSTR1, credit will reflect to Y in one form called GSTR2A and GSTR2B. Now, what is the exact difference between 2A and 2B? And I'm shocked that a lot of people talk different language. Ridiculous. It's very important that you have a clarity between what is different between GSTR2A and GSTR2B. Listen carefully. If supplier files GSTR 1 within due date, then credit will reflect in 2A and 2B. Come on, credit will reflect where, sir? In 2A and 2B. But other side, you see, if supplier files GSTR 1 after due date, that means what? He filed. I repeat, he filed. I repeat, he filed, but he filed when? After the due date. Then not old, credit will reflect in 2A, but not 2B. But please note that it will come in 2B of next month. It will come in 2B, but not come in 2B of this month. It will come in 2B of next month. Now, what difference it makes if it is in 2A? What difference it makes if it is in 2B? That clarity of thought is very, 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 very important. Listen carefully. This is relevant for yearly reconciliation. Come on, friends. 2A is relevant only for what's a yearly reconciliation. And 2B is relevant for claiming ITC on monthly basis. Monthly, whatever you are claiming credit, you can claim only after comparing the GSTR 2B. And how much you can claim credit is only maximum 105% of credit reflecting in 2B. That means, for example, for one person, Mr. A, 2B figure is 1 lakh. Actual credit is 1,10,000. Come on. Actual credit according to me is how much, sir? 1,10,000. But in 2A, how much is reflecting only 1 lakh. Now, what you can claim is only 1,05,000. In fact, my dear friends, from examination standpoint only, this answer is 1,05,000. But let me tell you, for November exam, it won't be 1,05,000, it will be 1 lakh only. Because recently they amended, stating that with effect from January 2022, they clarified very clearly that what you can take credit is only what is there in 2B. You can't claim anything more than what is there in 2B. But of course, for May 22 exam, the answer is 105% of credit reflecting in GSTR 2B. Interesting concept. Exam question also has come. And it will come because the concept is important. And our test students are confused. What is 2A? What is 2B? What is 3B? They are writing 2A is brother of 3B, 2A is brother of 3B, and 2B is sister of 3B. Nonsense answer. Don't write whatever you want. And don't write what you know. Write what is correct. Please. And what you know should be what is correct. That's very important. Clear? Excellent. Good. I love the participation. So without delay, my dear friends, let's proceed to next discussion. Come on. Yeah. Come on. Who is eligible to claim input tax credit? 16 deals with eligibility and conditions to be satisfied in order to claim input tax credit. Who is eligible to claim the credit and what are the conditions to be satisfied in order to claim the credit? That's what we are trying to understand. Come on, see now. Every registered person, obviously, common sense point, unregistered person can obviously not take credit. Every registered person shall be entitled to ITC of GST charged on inward supply of goods or services. Obviously. And ITC will be available on goods or services which are used in the course or furtherance of business. Obviously, if it is personal use, there is no question of claiming credit. And personal use credit is also very clearly blocked under block credit given under section 17, subsection 5. Next, thus, tax paid on goods or services which are used or intended to be used for non-business purpose cannot be availed as credit. And ITC will be credited to electronic credit ledger, obviously because we show that ITC in GSTR 3B. I told you that every month we will file GSTR 1, GSTR 3B. 1 is only a statement of outward supply, but whereas GSTR 3B is a summary return where we show both outward as well as inward. Next point. The registered possession entitled to ITC only if his following 4 conditions are fulfilled. What are the conditions? First one, he must possess a tax-paying document. Generally, it is invoice, or it can be a debit note, or it can be a bill of entry. Bill of entry will come in case of import of goods. In case of import of goods, importer will file a document called bill of entry. And in case of import of goods, we pay customs duty and we also pay IGST. We pay what, my dear friends? Customs duty, and we also pay IGST. That IGST, what we are paying, that we can claim it as credits. So what is the first condition? He must possess a tax-paying document. Condition number 2, he must receive goods or services. Condition number 3, tax must be paid. Who must pay the tax? Supplier must pay tax to the government. So condition 1, receiver must have a tax-paying document. Condition number 2, receiver must receive goods or services or both. Condition 3, supplier must pay tax to government. Condition number 4, receiver must file return. Obviously, because he will only take credit. And GSTR 1 is not a return. GSTR 1 is only a statement. So if these 4 conditions are satisfied, then only, my dear friends, receiver can take credit. And just for your understanding, presently, a summary return in 3B is being filed on monthly basis. So thus, taxpayers should file GSTR 3B to avail ITC on eligible inward supply. Without filing 3B, how can he claim credit also? Basic fundamental point. Next. Key points. I just discussed that with you, my dear friends. How much he can claim is only 5%. This 5% story that I already told you. Maximum what he can claim is only 5% of that credit, which is reflecting in GSTR 2B. He can never claim more than that. But of course, that is amended. But for exam standpoint, it is 105%. Please. Next. And what are the documents, my dear friends? Invoice, debit note, bill of entry, revised invoice. So any document should be there with us in order to claim the credits. And this point is no more relevant now because it was earlier 20% actually. 20% they brought to 10%. Again, they brought that to 5% again. And no credit can be claimed if related to demand or fraud. Obviously, if the tax is paid on account of fraud or misstatement or suppression of facts, there is a question of claiming ITC. Next point, important points. If the goods are received in lots or installments, if the goods are received in what, my dear friends? Lots or installment. Invoice is one, but the goods are coming in parts. Invoice is one, but the goods are coming in parts. Then they clearly clarified that please take credit only upon receipt of last lot or installment. Come on, friends, what is the language given in the law? If the goods are not received in a single consignment, but are received in lots or installment, ITC can be taken only upon receipt of last lot or installment. We'll wait till the last lot or installment. And this point, very, 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 very important point. High possibility that question will come in the exam. And according to me, it should come, it will come. Because very powerful, fantastic concept. That is, my dear friends, receiver can happily take the credit if all the 4 conditions are satisfied. What are 4 conditions? Condition number 1, receiver must have a tax-paying document. Condition number 2, receiver must receive goods, services, or both. Condition number 3, supplier must pay tax to government. Condition number 4, receiver must file return. So if all these 4 conditions are satisfied, receiver can happily claim input tax credit. In that, there is no problem at all. But the issue here is receiver, even though he can happily claim credit, there is one point given in the law which says that receiver should make payment to supplier within 180 days from the date of invoice. And by any chance, for any reason, if receiver fails to make payment to supplier within 180 days from the date of invoice. 180 days from when, sir? Date of invoice. Whatever credit he has taken, that credit must be reversed. That means paid to the government along with interest. And again, when you make payment to supplier, again claim the credit. But whatever interest you pay, that is gone. Gone. So friends, what is the language I'm talking, my dear friends? Receiver can claim credit if the 4 conditions are satisfied. However, if recipient does not pay to supplier, what is not paying? The value along with the tax. If he is not paying within 180 days from the date of invoice, then whatever credit he has taken, he must reverse the credit. That means pay to the government along with interest at 18% per annum. And after he makes payment to supplier, again he can reclaim the credit. 180 days. And this point is important. In case part payment has been made, proportionate credit would be allowed. You made half payment, please take half credit and reverse the balance half. This condition of 180 days, my dear friends, will not apply in following situations. Which case it will apply? Case number 1, supplies on which tax is payable under reverse charge. So for RCM cases, this condition will not apply. Condition number 2, deemed supplies without consideration, given by section 7(1)(c), read with schedule 1, which talks about transactions regarded as supply even though there is no consideration. Now, when there is no consideration, there is no question of making payment to supplier. Finally, last point, additions made to value of supply on account of supplier's liability in relation to supply being incurred by recipient. That means supplier's obligation. Come on, whose obligation? Supplier's obligation in relation to supply is met by recipient. Supplier's obligation in relation to supply is met by recipient. So for these cases, my dear friends, this 180 days condition will not apply. Very logical also. And finally, what is 180 days condition? Receiver can take credit if all the 4 conditions are satisfied. However, if he fails to make payment to supplier within 180 days from date of invoice, whatever credit he has taken, he must reverse that is paid to the government along with interest at the rate of 18% per annum. But the credit can be reclaimed after making payment to supplier. But the interest gone is gone. Next. Depreciation is claimed on tax component. Simple answer. If an asset is purchased for 1 lakh, let's say one laptop you purchased, 18,000 is the GST component. Total is 1,18,000. Simple answer. If you are claiming input tax credit, you should claim depreciation under income tax only on 1 lakh. Imagine under income tax, if you charge depreciation on 1,18,000, under income tax, if you would have charged depreciation on 1,18,000, then forget input tax credit. And very logical also. You cannot take both credit as well as depreciation on tax component. So what is the concept, my dear friends, here? If depreciation is claimed on the tax component, if what, my dear friends, depreciation is claimed on the tax component, then input tax credit is not allowed. Straight simple concept. Very powerful but very interesting. And finally, 16.4, my dear friends, time limit for availing credit. I already told this point to you. Same like credit note, that is due date of return for September month following the end of financial year, or date of filing annual return, whichever is earlier. And this question, a 2 marks question can come. What is the reason for that? And the reason is very clear that no change is permitted. No change is permitted after due date of this or annual return, whichever is earlier. That is the maximum time limit to make amendment also. However, my dear friends, this time limit will not apply for reavailing of credit reversed earlier. So whatever credit has been reversed, which you are again reclaiming that credit, for that, this provision of time limit will not apply. That point definitely has to be kept in mind, no doubt about it. Clear, my dear friends? Excellent. Utilization of credit, already I taught you this, my dear friends. Already we discussed this interesting concept. This concept, restriction on utilizing credit, my dear friends, it is important that you have to use that, you have to carry on the business properly in case where you are not carrying on the place of business, you are taking credit without receipt of goods, or tax is not paid to government, or is not having invoice, then whatever credit you availed, they will clearly tell you can't use it. And commissioner or any officer not below the rank of assistant commissioner. Who's that, my dear friends? Any commissioner or an officer not below the rank of assistant commissioner is empowered to impose restrictions on utilization of ITC. So he can impose restriction on utilization of ITC if he has reasons to believe. What he has to believe, my dear friends? Reasons to believe that such ITC has been fraudulently availed or ineligible. You are not allowed to take that credit, but still you have taken that credit fraudulently. Or ineligible credit you have taken, my dear friends. In that case, commissioner will impose restrictions saying that you can't use this credit at all. Clear? Exactly. Next, 86B. I'm sure you have heard this concept that this is applicable only for those where the value of supply is more than 50 lakhs, where they clearly told, for example, you have got ITC of 110 and output tax is 100 rupees. Can you entirely utilize and carry forward balance 10? But they're telling, don't utilize all this, my dear friends. Only utilize 99, but 1 rupee, please pay using electronic cash ledger only. So they're saying, please use credit ledger only to the extent of 99% of the tax liability. In cases where your value of supply is more than 50 lakhs. This story will apply only to those cases where value of supply is more than 50 lakhs. But the restriction will not apply to those persons who have paid tax more than 1 lakh in each of the last 2 financial years. In last 2 financial years, in each year you paid tax more than 1 lakh, or you got refund more than 1 lakh, or he had discharged his liability for an amount in excess of 1% of the output tax cumulatively up to said month in the current financial year. That means till date, he was paying amount more than 1% using electronic cash ledger. And moreover, this point will not apply to government department, public sector undertaking, local authority, statutory body. So for this category of persons, this special provision called Rule 86B of restrictions on utilizing credit will not apply. Make sense, everybody? Excellent. Next, moving forward. ITC special circumstances. Let me draw a small table to give you clarity on this. So let me talk about some special interesting circumstances availing credit in special cases. Section 18.1. This will divide into 18.1a, 18.1b, 18.1c, finally last one, 18.1d. Listen carefully. 18.1a is you applied for new registration, that too you applied within 30 days. So sweet of you. I hope we know that any person who is liable to be registered must apply for registration within 30 days. And the gentleman is a very sweet guy. He applied within 30 days. Then law is telling he can claim ITC on inputs held in stock, inputs contained in semi-finished or finished goods in stock. Come on what he can claim ITC, my dear friends? He can claim ITC on inputs, that is stock, which is there in hand. And he can also claim credit on the stock, which is in semi-finished progress, work in progress, or finished goods in stock. Come on, friends, what is the language? He can claim ITC on, inputs held in stock, inputs contained in semi-finished or finished goods in stock. This great privilege they'll give only to those category of persons who applied for registration within 30 days from the date they are liable. Yeah, I hope we know that. Registration topic, section 22 we have, section 24 we have. 22 deals with persons liable for registration, 20 lakhs, 40 lakhs, 10 lakh story, and 24 talks about compulsory registration where registration is mandatory even though turnover does not exceed threshold limit. So those persons who are liable for registration under 22 or 24, they must apply for registration within 30 days. And if they do that, then they are given a great benefit called whatever stock is there on that stock, please take credit. But there's one catch point to be noted here, that they told that this stock should not be older than 1 year. This stock should not be older than 1 year. See now, 18(1)(b), simple concept. This is a case of voluntary registration. That means somebody who is not liable for registration but voluntarily has taken registration. Law is telling we'll apply the concept same as 18(1)(a). Same as 18(1)(a). That means what? He can claim ITC on inputs held in stock, inputs contained semi-finished, or finished goods in stock. 18(1)(c), you are converting from composition to normal. Very, very interesting case. And already we learned the concept, my dear friends. If somebody is converting from composition to normal, government is extremely happy because he was paying tax till date on quarterly basis. Now we'll start paying tax on monthly basis. So government is at any given point of time, they're very happy. So they're telling, we'll give you some benefit. What benefit we'll give you is 18(1)(a) plus, what is 18(1)(a)? ITs or inputs held in stock, inputs contained in semi-finished or finished goods in stock. Plus, we'll also give some benefit. That is ITC on capital goods. That means what? Assets. Capital goods are those goods which are capitalized in the books of accounts. On that goods, minus 5% per quarter or part thereof. The logic of this 5% is very clear, that GST law believes that any asset useful life is 5 years. 5 years is nothing but 60 months. 5% per quarter means in a year, how many quarters are there? 4 quarters, 20%, 5 years, 100%. Simple logic, pure mathematics. So what is the benefit you'll get, my dear friends? If you observe carefully, 18(1)(a), 18(1)(b will get credit only on inputs, but we don't get credit on capital goods. But 18(1)(c), credit is allowed on inputs and also on capital goods. But the credit on capital goods is reduced by 5% per quarter or per thereof. Next point, 18(1)(d). This applies only in case where registered person. This applies only to a registered person who was dealing in exempt supply, and that exempt supply has become taxable supply. So it is a basic fundamental thumb rule that if output is exempt, then input credit is not allowed. Come on, friends, what is the language I'm saying? If output is exempt, then input credit is not allowed. But if output is taxable, then input tax credit is allowed. Now, for example, if Shiva Teja is dealing in some product which is exempt, so there is no question of claiming input tax credit. But suddenly one fine day, the exempt product has become taxable product. Law is telling Shiva Teja, enjoy, take credit, same as 18(1)(c). That means what? You can take credit on inputs. You can also take credit on inputs. You can take credit on capital goods also, but reduced by 5% per quarter of part thereof. But if you want any of this, you actually have to file ITC 01. And also, my dear friends, if the credit is more than 2 lakhs, you should get certificate from a practicing chartered accountant or cost accountant. This rule is there in the law. And this concept is given by Rule 40 of CGST rules. High possibility that question will come in the exam. And 18(2) clearly says that the credit what you want to claim on the stock, that stock should not be older than 1 year. That stock should not be older than 1 year. This point is given by 18(2). Now, some interesting reverse case I will tell, given by 18(4), my dear friends. 18(4) reverse case is 2 cases. 18(4) reverse case is 2 cases. Number 1, taxable has become exempted. Number 2, you have converted from normal to composition. So these 2 cases are reverse of 18(1)(c), 18(1)(c), and 18(1)(d). 18(1)(c) told what? Composition to normal. 18(1)(d) told what? Exempted became taxable. But now I am talking about taxable became exempted, or from normal you converted into composition. These 2 cases, what they told is you have to pay There they told claim credit, but here they are telling you have to pay. Very logical, because when you have exempted became taxable, law is very happy because henceforth you're going to pay tax. So they're telling whatever stock is there, you take credit. But this reverse case where you are dealing in exempted and exempted has become, you are dealing in taxable, taxable has become exempted. Law is telling boss, whatever stock is there, on that what credit you have taken, pay that to government now. What do you pay? ITC on inputs held in stock. Come on. Inputs contained in semi-finished or finished goods in stock. Come on, friends. What is the first one? What is the first one? Come on. ITC on inputs held in stock, inputs contained in semi-finished or finished goods in stock. Plus ITC on capital goods. Here there is a small difference. There we learnt about ITC on capital goods minus 5% per quarter of part thereof. But here the difference in the concept is that ITC on capital goods proportionate to remaining useful life in months by taking useful life as 5 years. That means what? 60 months. So if 40 months is over, 20 months is left out. And let's say the credit is 18,000 rupees. Credit is 18,000 rupees. 40 months life is over. 20 months life is left out. Then what will you do? 18,000 into 20 divided by 60. We'll get the figure as 6,000. That figure you should now pay. You should now pay. And another interesting point they told is, after paying, if there is any balance in electronic credit ledger, then it shall lapse, my dear friends. Come on. After paying, if there is any balance in what ledger? Electronic credit ledger, then it shall lapse, gone, finish, matter is over. Getting clarity, friends? Very, 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 very interesting and important concept. High possibility that question will come. And finally, let me also teach you 18.6 so that the section 18 is over. That 18.6 is supply of capital goods on which ITC is claimed. That means what? You purchase some machine on which you enjoyed ITC, but after a point of time, you are selling that machine. You purchase one machine on which you enjoyed ITC, and after a point of time, that machine is being sold. Then they told you have to pay. You have to pay higher of, number one, tax on transaction value. That means what value we sold into the tax percentage. Or number two, ITC minus 5% per quarter or part thereof. That means, for example, 1 lakh asset, GST is 18%. GST is 18%. You used for 10 months. And after that, you sold it for 60,000. Then how will you calculate the working? Simple working. First option, 60,000 into 18%. Second option, 18,000 minus 5% per quarter for 4 quarters. That means 20% is gone. Let's do the working. Come on. Let me open my calculator. Let's see the working. 60,000 into 18%. 60,000 into 18%. One second, guys. It's playing games with me. Hold on. Yeah. 60,000 into What is the problem with this? $60,018% is 10,800, my dear friends. How much is the figure? 10,800. So the first figure is 10,800. Second figure, 18,000 minus 5% per quarter for 4 quarters. When I say 4 quarters, that means what? 20% is gone. So what is left out? 80% is left out. 18,000 into 80%, 14,400. So 10,800 or 14,400, whichever is higher, which is nothing but 14,400. This is the interesting concept given by section 18.6, which deals with supply of capital goods on which input tax credit is claimed, where you have to pay higher of the following two. Number one, tax on transaction value. Number two, ITC minus 5% per quarter or part thereof. Come on, going back. That is the end of story of this beautiful section, section 18, my dear friends. 18.1a we discussed, 18.1b we discussed, C we discussed. In C only you will find a special word called capital goods. 18.1d, but 18.1d applies only for a registered person whose exempt supply has become a taxable supply. Keep in mind that word, registered person, for whom exempt supply has become taxable supply. Next. 18.1a, 18.1b, C and D. Brilliant. And I already told you about the story of 2 lakhs certificate. And 1 year, the stock should not be older than 1 year. That point also I told you. Next, 18.3, if there is a change in constitution of business, like there is some sale, merger, demerger, amalgamation and all, credit also will get transferred, obviously. For that, you have to file ITC 02, and you have to get certificate from chartered accountant or cost accountant. You can read this word. Transferor shall also submit a copy of certificate issued by chartered accountant or cost accountant, certifying that the sale, merger, demerger, or transfer of business has been done, along with transfer of liabilities, not just asset. Please transfer liabilities also. Only then the credit also can be transferred. Obviously, you cannot just transfer asset until business is transferred. You can never do that. Next. Switching from normal levy to composition levy, or from taxable levy to exempt supply. I already told you that you have to pay that, reverse it. What you have to reverse? Credit you have taken on inputs and also on capital good. And if invoices are not available, please do on the basis of prevailing market price. Very dangerous provision they gave. And that needs to be certified by a practicing chartered accountant or cost accountant. And after paying balance of the credit ledger, that will definitely lapse, my dear friends. This point also is given in the law that after making the payment, balance in credit ledger shall lapse, gone. Finally, 18.6, very important. Supply of capital goods on which ITC is taken. Pay higher of the following. Tax on transaction value. Second, ITC minus 5% per quarter or part thereof. But finally, one last point, my dear friends. In case of refractory bricks, molds and dies, jigs and fixtures, which are supplied as scrap, then you can directly pay tax on transaction value. You can directly pay tax on what value, sir? Transaction value. Next point, section 17. Let me talk about the story of section 17.5. Because in your syllabus, they removed this concept of apportionment of credit, where they told if I'm using for both exempted and taxable, how do we apportion the credit? In case of banking company, there's an option called take 50% credit, balance 50% ignore. Like that concept is there in banks. But in normal cases, there is a special provisions called apportionment given by Rule 42 and Rule 43. Once upon a time, that was a part of syllabus for CA Inter, but they removed that. Now for CA Inter syllabus, there is no Rule 42 and 43. That is not a part of syllabus. Clear? See now. Let's talk about section 17.5. The cases where credit is not allowed. Let's see. That means what? Credit is blocked. That's why we always say, my dear friends, credit is blocked. That means even though they are related to business use, still you can't take credit. Section 17, subsection 5. And 101% question will come in the exam. And every time we are seeing a question on the concept of block credit. See now. First one. ITC is blocked on purchase of motor vehicle used for passenger transport. That means if the vehicle is related to transportation of goods, then definitely credit is allowed. So if Shiva Teja purchases one BMW car for official use, still I cannot take credit. But if it's a goods vehicle, then definitely credit is allowed. Next. Motor vehicle for this purpose means any motor vehicle used for transportation of persons with seating capacity not more than 13, including driver. So if the capacity is more than 13, then definitely credit is allowed. So if software company or any kind of company, if they purchase one bus, 50-seater bus, then credit is allowed. But if they buy a 6-seater car, then credit is not allowed. Exceptions you see. Number 1, for making further taxable supply. That means you purchase a car, so sell the cars, you are a car dealer, then definitely credit is allowed. Number 2, making taxable supply of transportation of passengers. You are in the business of transporting passenger. Number 3, you are making taxable supply of imparting training on driving such motor vehicle. That means you are acting as a driving school. Then also credit is allowed. Next, motor vehicle used for transporting goods, dumper, tipper, lorries and all, or Tata Ace, Chota Hathi, those are cases credit is allowed. Next, motor vehicle for transportation of person with seating capacity more than 13 persons. Then also credit is allowed, my dear friends. No doubt about it. Clear? Same concept, but 17.5 clause AA, which deals with vessels and aircraft. 17.5 clause A was dealing with motor vehicle. Clause AA deals with vessels and aircrafts. I hope you are getting clarity, friends. Excellent. Then 17.5 clause AB. ITC is not allowed on service of general insurance, servicing, repairs, maintenance relating to motor vehicle, vessel, aircraft. ITC on which is not allowed. That means when Shiva Teja purchased BMW car, credit is not allowed. But the same car, I take it for servicing. Whatever bill they charge on servicing along with GST, that GST also I can't take credit. They have clearly clarified. If you can't take on vehicle, you can't take on servicing, repair, maintenance also. But if it is 50-seater bus, 50-seater bus, can we take credit on the vehicle? Yes. And the same vehicle, if you take insurance, servicing, repair, maintenance, that also you can take credit. Next one. ITC is allowed on such services when received by manufacturer of such motor vehicle. ITC is allowed on services when receiver is engaged in general insurance business. You have taken insurance to provide insurance, then credit is allowed. And you also can't take credit on leasing, hiring, and renting of motor vehicle. But ITC is allowed when the same category is used for same supply. That means you have taken vehicle on rent to provide vehicle on rent. You have taken vehicle on rent to provide vehicle on rent. Then definitely credit is allowed. Or if it is provided by employer to employee under a statutory obligation, not a company law. It is not a company internal rule. It is not a company policy, but it is a statutory obligation. Then credit is allowed. That means government specified that it is your obligation to provide this renting of vehicle of aircraft or vessels and all. Then definitely credit is allowed. Same logic. Food and beverages, outdoor catering, health services, beauty treatment, cosmetic and plastic surgery, life insurance and all, credit is not allowed. But if you have taken that service to provide that service, then definitely credit is allowed. So you have taken food to supply the food, then credit is allowed. Or when it is provided under a statutory obligation, then also credit is allowed. Whenever it is provided by employer to employee under statutory obligation, government obligation, then definitely credit is allowed. So 17.5 clause A was what? Motor vehicle. Clause AA, vessels and aircraft. AB, general insurance, servicing, repairs and maintenance. 17.5 clause B, leasing, renting and hiring of motor vehicles. This is clause AB actually. Then 75 clause B is what? Food and beverages, outdoor catering. Then 75 clause B, it also covers membership of a club, health and fitness center. That also criteria is not allowed. Even the official use still not allowed. Travel benefits given to employees on vacation, such as leave or home travel concession. That also criteria is not allowed. Then works contract service. What is works contract service? I already told you that is a contract where there's element of goods as well as service. And this word exists only in case of immovable property. So if you take any works contract service, criteria is not allowed. But one important word called construction. What is the meaning of this word construction? Construction includes reconstruction, renovation, addition, alteration, repairs to the extent of capitalization. This word is an important language. If reconstruction, repairs, additions, alterations are not capitalized, that means they are revenue in nature. They are minor repairs, they are revenue in nature. Then what will happen? It would not tantamount to construction under GST law. Thus, when it is not capitalized, ITC is allowed to all recipients, irrespective of their line of business. So if it is capitalized, then credit is not allowed. If it is revenue in nature, then definitely credit is allowed. And capitalization does not depend upon whether taxpayer has intention or not, but it is based on accounting standards and GAAP, generally accepted accounting principles. It's based on that. You cannot tell, I will not capitalize because credit will not come. I'll charge off to my P&L account. You can't decide like that. Next point. Exception. Credit is allowed if works contract service is taken for further supply of works contract service. You have taken works contract service to provide works contract service. Then definitely credit is allowed. And second possibility, if it is for construction of plant and machinery, then also credit is allowed. Now, what is plant and machinery? It means any apparatus, equipment, and machinery. Apparatus, equipment, machinery, which is fixed to the earth, either by foundation or structural support, that are used for making outward supply of goods or services, and include such foundation or structural support, but excludes number one. What is not covered there? Number one, land, building, or other civil structure. What is number one? Land, building, or other civil structure. Number two, telecommunication towers. Number two is what? Telecommunication towers. Number three, pipelines laid outside the factory premises. These three are not covered in plant and machinery. That means for these three things, credit is not allowed. Next one. Self-construction of immovable property, goods or services for own account. If you are constructing building to sell that building, then credit is allowed. Because you are a builder who is constructing an apartment, then credit is allowed. Of course, a practical point, even for apartment also, they made the GST rate as 5% without any input tax credit. A new interesting amendment which came up in 2019, just for your knowledge. Next point. Inward supply charge to tax under composition levy. Obviously, composition levy, there is no question of claiming credit at all, because there is no question of invoice. There is only a question of bill of supply. Next, inward supply received by NRTP. Who is an NRTP? Non-resident taxable person who has come to India only for a temporary period to carry on business for a temporary period, and he will leave India once the business is done, where he will take registration, and that registration is valid for a period specified in the application of 90 days, whichever is earlier. And he has to apply for registration at least 5 days prior to commencement of business. He does not have a fixed place of business or residence in India. So what he can take credit? He can take credit only of the tax paid on imported goods. So see here, ITC on goods imported by NRTP is allowed. Service imported by him is blocked. So he can't take credit on anything, but he can take credit on goods imported by him. Next point. Inward supply is used for personal consumption. Obviously, when it is personal, there is no question of claiming credit. Next point. This point is very important. High possibility question can come. Credit is not allowed on goods lost, stolen, destroyed, disposed of, or written off by way of gift or free samples. So give something as gift also, you can't take credit. A lot of times for giving gift to the employees, people may buy items and the items are given as gift to the employees. That items, whatever GST they pay, they can't take it as credits. It's very clearly given in the law by section 17.5 clause H. So what is the point? Goods lost, stolen, destroyed, disposed of by way of gift or free samples. Finally, buy one get one free, the story already we discussed. Return of time expired medicines. That means what? Expired medicines. The retailer can return the time expired medicines either by treating the same as fresh supply or by issuing a credit note. And when the goods are returned, the retailer wholesaler as a fresh supply are destroyed by the manufacturer, obviously destroyed because they're expired. He is required to reverse the ITC availed on the return supply as per 17.5 clause H. Then finally, 17.5I, any tax paid on account of fraud, misrepresentation, or suppression of fact, or any detention of goods or confiscation of good, you have done a wrong thing. And because you have done a wrong thing, you paid some amount. And that amount you have paid, which you paid because doing a wrong thing, that you can never take it as input tax credits. Finally, that is the story of section 17.5, which deals with the concept of blocked credits. And finally, friends, apportionment principle. I told you that if something related, if any goods or services are used for both taxable as exempted, we call it as common credit, which will apportion. And the rules are there for you at CA final level. But what you need to know here is only about the concept of banking companies, where they have got option 1, where they can do the apportionment. Option 2, straight away claim credit 50% and balance 50% is gone. But the option once exercised cannot be changed during remaining part of the financial year. Simple concept. But other than banks, there is a rule called Rule 42 and 43, which is not there as a part of your syllabus, but is there for you at CA final level, which we'll learn soon. Don't worry. And that is the, before that, one last point. Credit of tax paid that are used for personal purpose and block credit that you anyways can't claim. Obviously, no. And the restriction of 50% will not apply on the tax paid on supplies procured from another registration within the same entity. That means what? Distinct persons. PAN is same, but GST number is different. So SBI of one branch to SBI of another branch, different state. PAN is same, GST number is different. There you will not apply 50% concept. There you take full credit. Balance only, 50% you take, balance 50% you forget. That is the story of this beautiful concept of block credits, and that is the story of the beautiful concept of apportionment of credit. And that is about this fantastic discussion on what, my dear friends, input tax credits. So friends, thank you so very much for your time and effort, especially because of your time, what you have given. I could spend time on discussion about the concept of time of supply, value of supply, input tax credit, composition scheme, and cases where RCMA is applicable. We have spent time on discussion about the concept of supply, and we discussed some interesting concepts related to payment of tax and registration chapter. Anyways, you guys have got a lot of clarity on 22 to 30 persons liable, not liable, compulsory registration procedure and all. You anyways have to learn that concept, no doubt about it. But also ensure that, my dear friends, topic like invoice, e-way bill, where it's more than 50,000, e-way bill generation is mandatory, validity of e-way bill, 200 kilometers one day, extra kilometer, extra day will come. All these small point keep in mind. And invoice, also remember the story of e-invoicing, which is mandatory where aggregate turnover is more than 50 crores for exam point of view, but practical point of view, from 1st April 22, it became 20 crores. So learn these concepts also. Clear, friends? Very, very important area and very scoring area also for that matter. Clear? So with this discussion, my dear friends, I'll complete the story, and at the same time, I'll also wish you all the very, very best. And I wish that you guys have a great success and come out with flying colors and write the exam exceptionally well. And I strongly believe and I strongly wish that you guys will perform extremely well in the exam. All the very best, my dear friends. Wish you all success. Do perform very well in the exam. And this is not the end of the story. Any doubts on any topic, small topic, bigger topic, silly doubt, talented doubt, any doubt is a doubt. Feel free to get back. We at Indigo Learn will be more than happy to answer all your queries. So any doubt you get, feel free to comment in the forums. We'll be more than happy to reply, or on any YouTube video, I'll be more than happy to reply. Wish you all the very best, my dear friends. Thank you so very much for all your time and effort. Thank you. Take care. Bye-bye. Thank you so much.